Okay, today's lecture is called Cost Behavior and Cost Volume Profit Analysis. This is not a difficult topic, and the concepts in this chapter are probably some of the most useful concepts that you'll take with you to business, and they're going to follow us for the rest of 102, or for most of this program. And so it's an important chapter, but it's not that difficult a chapter. And it revolves around basic concepts, and that is cost, volume, profit, meaning how does cost behave when there's changes in production levels. So let's just take a look at the three primary components. We have variable costs, fixed costs, and mixed costs. Variable costs vary as production quantities vary. As you produce more, you incur more variable costs. Raw materials, direct materials are variable costs. Okay, supplies, variable cost. Direct labor is kind of unique. In this class, we'll consider it a variable cost, but there's an argument to be made that it's a fixed cost. Okay, but we're going to consider it to be a variable cost, recognizing that some companies will classify it in one of the two categories. All right, now fixed costs don't change. That's why we call them fixed. Your rent each month is fixed. So if I rent a production factory, whether I manufacture 10 units, 100 units, or 1,000 units, my rent will stay the same. Straight line depreciation, we call it straight line because it's fixed. It doesn't change. Okay, and so a variety of costs are fixed. And then we have something called mixed. Your book may use the term semi-variable costs. And these costs have a fixed component and a variable component. And most of you are actually familiar with the concept. If you've ever rented a U-Haul or a Ryder rent-a-truck, it's something like 29 bucks a day or 39 bucks a day plus 50, 60, 70 cents a mile. That's a mixed cost because the 39 in the slide is fixed, the 75 cents per mile is variable, which is why we don't want to make any more trips than is necessary because that mileage starts to run up a tab. Your cell phone, many cell phone plans are, for example, $49 per month plus 30, 40, 50 cents per minute once you've exceeded your anytime minutes or your prime time minutes, whatever they call it. Okay? And so these are the three different types of costs that we have in any business. Okay? Now, I would like you to know these graphs. I'm not going to ask you to prepare a graph, but I could ask you to analyze a graph. Let's just take a look at these graphs. Notice it says total variable costs and variable costs per unit produced. Okay? The more cars we produce, the more engines we need. Okay? So we incur increasing costs as production increases. However, if I buy the engines or tires or some other car component from one of my vendors, I've contracted to pay a fixed price per unit. Okay? Now don't confuse the terms. Variable costs per unit stay roughly the same. Now remember, these are assumptions we're making. Anytime you make assumptions, there's always the chance that the assumptions will not hold. But in many businesses which have a relatively stable environment, it's not an unreasonable assumption, okay, that your variable costs on a per unit basis stay the same. Okay? And again, recognizing that in certain circumstances, if you didn't order enough, you have to rush ship goods, your variable costs might increase. But as a general rule of thumb, variable costs stay the same on a per unit basis, and they increase as we produce more items. Okay, fixed costs. Fixed costs in total don't change. If you're paying $10,000 rent for your factory, then regardless of how much you produce, your total fixed cost will stay the same. Now notice what happens to fixed costs per unit. And you have to interpret the information correctly. If I manufacture one item and my rent is $10,000, then I have to charge that product $10,000 if I want to recover my costs. If I can produce 2 units, then I can divide the $10,000 between the 2 units, and it would be $5,000 per unit. If I can produce 1,000 units, then 10,000 divided by 1,000 units, then I have to make sure that the cost of my product includes $10 of rent per unit. If I produce 10,000 units, then I only have to charge $1 for each unit produced to recover my fixed rent cost. As a result, the more we produce, the fixed cost per unit decreases. Okay, Okay, and these are important concepts for any business to understand, is which costs are variable and which costs are fixed. Now let's take a look at the mixed cost graph using your cell phone plan or renting a U-Haul truck as an example. Costs that have both a variable component and a fixed component. So there's the fixed cost component at the $50,000 level. Then there's the variable cost component, the red line going from the $50,000 mark. Okay, so even if you didn't use your phone one single minute, you'd still be charged $50, for example. Okay, if you stayed within your 600 anytime minutes, then you get hit for $50. If you run over, say you have 800 minutes, then that red line starts to kick in. And the more minutes you exceed your limit, then of course the higher your bill is going to be. Okay, so a lot of different costs are mixed costs, and you can look at various departments. For example, the quality control department. That department has a lot of different costs in it, some of which are variable, some of which are mixed. So the department, most departments are mixed costs, and what we have to do is we have to separate mixed costs, or a department with mixed costs, into the variable components and into the fixed components. Then we're left with two neat, clean categories, variable costs, fixed costs, and then we can start doing what's called break-even analysis, cost volume profit analysis, what we call what-if analysis. And it's very useful for many businesses. Another term you need to be familiar with is this concept called the relevant range. This is the production level that we expect to produce under normal operating conditions. Normal operating conditions takes into account imperfections in human beings and in running a business. Notice we have ideal capacity. This is under perfect conditions, which rarely, if ever, happens. I'm going to say never happens. And then we have normal expected capacity when we factor in that sometimes people work a little inefficiently. Sometimes machines break down. They have routine maintenance. Maybe there's a power outage. Who knows? Maybe raw materials get jammed in the machines. Okay, but you factor in a certain amount of inefficiency. You're not justifying the inefficiency. Your goal is, of course, to minimize or eliminate inefficiencies, but recognizing that until you reach that point, which most likely is never, okay, then normal expected capacity is the concept in which we're going to use to define the relevant range. Okay? And the four graphs that we saw, really the five graphs, including the mixed cost graph, are assumptions we make within the relevant range. And let's take a look at this graph here. Notice, total variable costs, the purple column in the middle is our relevant range. This is where we typically expect to operate, okay, in normal operating conditions. And notice, it's a relatively straight line. It's linear. Now again, in reality, there will always be exceptions to the rule, but again, with many businesses, this is a reasonable assumption to make because their business is somewhat predictable. Okay, now, fixed costs, look at the graph with fixed costs. If I exceed the relevant range, for example, if I'm going to produce, or if I want to produce more than my factory is capable of at full capacity, then I'm going to either have to knock out a wall, or I'm going to have to move into a larger building or buy more machines, and my fixed costs are not going to inch up, they're going to jump up by a measurable amount. Okay? So while we're in that relevant range, the expected capacity, our fixed costs will remain fixed. If we exceed that, then our fixed cost structure will change. So we're going to stick within the relevant range. Now, there are several techniques we can use to separate a mixed cost into its variable and its fixed components. One is called regression analysis. We're not going to look at that. You'll look at that in your probability and statistics class. Scatter graphs, which the book may discuss. Okay, we're going to focus on this estimation technique called the high-low method. Okay, and what we do is we identify the months or the time periods, however you want to define time periods, in this case months, which had the most activity, the high month, and we compare it to the month that had the lowest activity. So let's take a look at this graph. We'll easily identify the high month and the low month. Okay, the high month looks like August. Notice we produced the most units. We incurred the most total cost. And remember, I'm going to abbreviate variable costs plus fixed costs equal total costs. all of our costs will be categorized as either variable or fixed. Okay, and our mixed cost, we're going to now separate it into its variable and its fixed components using this high-low method. Okay, the low month, the least activity was October. Lowest amount produced, lowest cost incurred. So we're going to first identify variable cost per unit, and what we're going to do is the numerator, we're going to take the high month cost and subtract the low month cost. And in the denominator, we're going to take the high month activity, subtract the low month activity. Okay, let's take a look at that. There's some yellow ink here. You probably can't see that. It says difference in total cost in the numerator there. Okay, here's what we're looking for. Okay, so in the month of August, we produced 2,100 units, incurred 61.5 in cost. October, produced 750 units, incurred 41,250 in cost. So the numerator, high cost minus low cost, okay, there was a difference of 20,250. And in terms of the difference in activity between the high month and the low month, 21 minus 750, okay, there's a difference of 1,350 units. Now you need to think about what is this telling us. Is if you just memorize a formula, yes, you'll come up with an answer, but it helps to know what it means, okay, otherwise you're going to get tripped up. Notice that when we produced an additional 1,350 units, we incurred an additional 20,250 in costs. Okay, what does that sound like to you? That sounds like variable costs. As production increased, some of those costs increased. Well, those had to be variable costs because, remember, fixed costs don't change within the relevant range. So that 20,250 are additional variable costs we incurred as production level increased. And if you refer back to your variable cost in total graph, it's a linear line going up. Okay? Therefore, we divide 20,250 by 1,350 units, and we identify, and by the way, the denominator here says a difference in, so 20,250 divided by 1,350 equals a variable cost per unit of $15 per unit. Now, review your variable cost per unit graph, and remember, within the relevant range, it's straight, right? We assume, for example, that when Ford Motor Company signs a contract with Goodyear Tire and Rubber, they're going to buy several million tires for X number of dollars per unit. It's in a contract. The cost per unit stays the same. So we can now rely on this $15 per unit variable cost, and now we're going to be able to separate the 61.5 into its variable component and its fixed component. Okay. In the high month, we produced 2,100 units. Variable cost is $15 per unit, so if I multiply 2,100 units times $15 per unit, I get 31,500. Now we know that in the high month, our total cost was 61.5, and we know variable plus fixed equals total. If 61.5 is total, 31.5 is variable, then the difference, or 30,000, has to be our fixed cost. Let's look at the low month. 41,250 is our total cost. We produced 750 units at a variable cost per unit of $15 per unit. Variable cost 11,250. 11,250 plus X equals 41,250. And notice our fixed cost, which after all is fixed, stayed the same. It's 30,000 units. Okay? Now again, this is an estimation technique, and if you were to plug in the other 3 or 4 months, it wouldn't be exact. Okay, but if it was a normal operating month, it would get you pretty close. Now, if there was something unusual that happened in any given month, then your cost behavior would have changed somewhat. But in normal operating conditions, then this formula for this particular company will generate reasonably consistent results. Again, being an estimation technique, it won't be right smack on the money, but it'll be pretty darn close. Okay, so now what we've done is we've separated our total cost into a variable component, fixed cost component, and now all of our mixed costs have been pushed into those 2 categories. All costs are now neatly classified as variable or fixed. We can now start doing some analysis. Okay, now we want to introduce an important concept in this whole process called the contribution margin. How much does the sale of each unit contribute towards first covering fixed costs, and then after we've covered fixed costs, how much does each sale contribute to profit? Okay, so for each $1 revenue, what percent goes to covering, first we subtract variable costs, that leaves us with something called contribution margin, and that's the amount that we're going to contribute to covering fixed costs. Once they're covered, that's profit. Let's take a look at this new format. We haven't seen this before. This is called the contribution margin format for the income statement. And notice in parentheses we put not GAAP. We can only use this for internal analysis. That's what this class is about, managerial accounting, analyzing our business to make sure we're running it as efficiently and as effectively as possible. This type of information is not for outside eyes. Okay, a GAAP formatted financial statement, which should look familiar, is over there. And notice operating income will still be the same. We're simply rearranging our costs to help us analyze our business. Okay? Sales minus variable costs equals contribution margin, CM, minus fixed costs equals operating income. Okay? And what we'll see is that your cost of goods sold has a variable and a fixed component, and your operating expenses has a variable and a fixed component. Okay? So we've separated variable and fixed. So this number, variable costs here, includes part of cost of goods sold, part of operating expenses. Fixed costs will include part of cost of goods sold, part of operating expenses. Okay, so sales minus variable costs equals contribution margin. We also have to calculate what's called the contribution margin ratio. Contribution margin divided by sales gives us the contribution margin ratio, and this is the percentage of each dollar of revenue that contributes towards covering fixed costs, and then once fixed costs are covered, how much profit for each dollar of sales. Okay, so $1 of revenue, we subtract whatever the variable cost is per unit, which is a fixed number. Remember that? It stayed the same. That gives us contribution margin per unit. We can do this on a total basis. Sales minus variable costs equals contribution margin, and we can do it on a per unit basis as well. Okay? And then contribution margin, which again is sales minus variable costs, contribution margin divided by sales tells us the percentage of each dollar of revenue that helps to contribute to cover our fixed costs. So we're going to do some examples. The break-even point when revenue equals expenses, and all of our expenses are separated into variable and fixed components. We're not making money, we're not losing money, we're breaking even. How many units do we need to sell to break even? That's a useful piece of information for a business. What would revenue be at the break-even point? How many units do we have to sell if I want to achieve a profit of 50,000, 100,000, a million? Useful information for a business. We can also then figure out what would happen. What happens to break even if we raise the selling price a little bit? If we have to drop the selling price. If variable costs go up or down. If fixed costs go up or down, because let's face it, over time, things change. Your energy costs may change, your materials costs, your labor costs may change. You may buy new equipment, you may move into a new building. So nothing stays the same forever, but this formula allows us to modify our equations, and our break-even points will change under these circumstances, but we can still figure that out. Okay, let's take a look at this example. Our sales price for each unit we sell is 200. Our variable cost per unit, things like direct materials, direct labor, supplies, utilities, etc., 150, leaving us a contribution margin of 50. 200 minus 150 equals 50. Fixed costs in total are 500,000. Again, just think of rent, straight line depreciation, maybe property tax, insurance. Okay, our contribution margin ratio, therefore, is 50 divided by 200. 25% of each sale contributes to covering our fixed costs. What's the break-even point? So let's plug in this formula. Notice, each unit gets sold for $200. X represents the number of units we will sell to break even, to cover our costs. Each unit that we sell, we know the variable cost per unit is 150, and we know that our fixed costs in total are 500,000. So now let's take this the algebraic path. 200, let's isolate x. So let's subtract 150x from both sides, and we're left with 50x, which, by the way, is our contribution margin, equals 500,000, divide both sides by 50, X equals the 10,000 units of product that we have to sell to break even, to cover our costs. So our break-even point is 10,000 units of production. We don't really need to do these 3 steps. We can eliminate this first step by simply saying, here's fixed cost, here's contribution margin. We can simply say fixed cost divided by contribution margin per unit gives us the number of units we have to sell at the break-even point. And there it is, 500,000 divided by 50, 10,000 units. Now, we can use a slight variation of this formula to figure out how much revenue we would bring in at the break-even point, 10,000 units. And we take the fixed cost and we divide it by the contribution margin ratio, which we previously figured out was 0.25. Remember, 50 contribution margin divided by 200 sales price per unit. And we would achieve $2 million in revenue at the break-even point, which is easily proven. We know we sell each unit for 200. Break-even in units is 10,000. 10,000 times $200 per unit, our total revenue would be $2 million. So these are simply nice shortcuts that we can use to calculate break-even in units and break-even in dollars of revenue. From this, we can also factor in what we call target profit, and don't let fancy terms get you rattled. This simply says, hey, if I want to make $100,000 or $100,000 in profit, how many units do I have to sell? If I want to make $1 million in profit, how many more units would I have to sell? And we just do a slight modification of the formula, and we can figure this out. And look what we did. We said fixed cost plus target profit, add those two numbers together, that's your numerator, and divide it by the contribution margin. Okay? Now, from the previous example, and notice what it says. If we want to achieve a target profit of 250, then fixed cost of 500 plus the 250 target profit divided by the contribution margin of $50 per unit, we'd have to sell 15,000 units to achieve a $250,000 profit. And how much revenue would we bring in at that point where we're achieving 250 in profits? Well, fixed costs plus target profit, your numerator, divided by the contribution margin ratio of 0.25, we'd bring in $3 million of revenue. Okay, so it's actually a very simple formula, but it's very useful. Okay, and now we can do all sorts of what we call what-if analysis. Okay, we can say, what happens if we raise the sales price? What happens if we lower the sales price? What happens if we raise the sales price in response to an increase in variable costs? What if we bought a new machine that makes our fixed costs go higher, but as a result we use less labor, so our variable cost goes lower? So you can do all these different scenarios once you know your variable and fixed costs. Okay, so now we can do a variety of what-if scenarios. Let's go ahead and take a look at these. What if we change the sales price from 200 to 210? Well, literally just plug the new number into the formula. 210 sales minus 150 variable cost. Contribution margin's now $60 per unit. Use the formula. 500 fixed cost divided by the new contribution margin ratio. 8333 units to break even. Okay, hey, makes sense. If you can raise the price without your cost going up, you're going to achieve profitability sooner, less units to break even. Okay, now whether or not you can pull that off in the real world with competition demand remains to be seen. What if variable costs go up by $15 per unit, but we keep the original sales price? Okay, original sales 200, new variable costs 165, contribution margin is now only 35 per unit. Notice our formula is going to take over 14,000 units to break even. Okay, continuing. What if fixed costs increase to 575? Maybe we bought some new machines, better technology. But as a result, we use less direct labor, and now variable costs went from 150 down to 135, and we dropped the price, sales price, to 190 per unit. All three elements change. Well, just put all three elements in the formula. Okay? Our contribution margin is 190 minus 135. Okay, now fixed cost, 575 divided by the new contribution margin, 10,454 units of break even. And using this particular data here, if I want to achieve a $100,000 profit, 575 plus target profit of 100 divided by the contribution margin, 55, I'd have to sell 12,273 units to accomplish that profit. Now, we can also do this if we have 2, 3, 4, multiple products. So this is called the sales mix, determining break even with 2 or more products. Assume that a company has 2 products that it sells, products A and B, and in normal business, most of our business, 70% of our product sales relate to product A and about 30% for product B. You'll have your sales price information, your variable costs, therefore you have contribution margin. And here's the key here. We can still figure out break even, but we need to plug the sales mix, the 70-30 split between products A and B, into the equation. Okay, now, if you don't have a consistent sales mix, you can't use this technique. But a lot of companies do. They have a primary product and they have secondary products. So what we do, and here's the trick here, is we're going to multiply the contribution margin per unit times the sales mix for each product. $1.50 times 70%, and $2 times 30%. And then we're going to plug it back into our formula. Let's take a look. Contribution margin times sales mix percentage gives us WACM, which is simply the weighted average contribution margin. Okay, your book presents this as product E or product some, gives it a new letter. This is simply a weighted average contribution margin when you blend the 2 products, given the 70-30 mix. So 150 times 0.7 is $1.05. $2 times 0.3 is 0.6. Now add them together, and the weighted average contribution margin is $1.05 plus 60 cents equals $1.65. Take your fixed costs, which in the previous slide we saw were $3.30, divide it by your weighted average contribution margin, and we have to sell a total of 200,000 units. Now, this 200,000 units is comprised of products A and B. We got to separate product A and B, and for this we go back to our sales mix. 200,000 times 0.7, 70% of that 200,000, or 140 units, will be product A. And 30% of the 200 units, or 60,000 units, will be product B. And if we were to plug these in and multiply the number of units times the sales price, variable costs, etc., we would see that we do in fact break even. In fact, here it is. Okay? Total sales for A, that's the break-even units times the sales price per unit. Okay, variable cost per unit times the unit sold at break-even. You can go back on your own and you can plug these in, and in fact it's a good idea for you to do that, and then plug in these numbers and you will see that the contribution margin in total for the 2 products, 210 plus 120, gives you a combined contribution margin of 330. There's our fixed cost, 330. We did in fact break even. Okay, so it's useful even when you have 2, 3, 4, 5 products, providing you have a reliable sales mix. Last item, concept called operating leverage. Based on a company's cost structure, the percent of variable costs versus the percentage of fixed costs, we can tell what an increase in sales will do for the profit of the company. Companies with a higher fixed cost, more fixed costs than variable costs, will have a higher break-even point, but will have more operating leverage. And what that means is, as sales increase, your profit increases by a greater degree. And we'll see this momentarily. Companies with a higher variable costs and fixed costs have a lower break-even point, but they have less operating leverage, so as their revenue increases, their profitability will increase, but not as much from percentage point as a company with high operating leverage. Let's see it in action. Here's our formula. And this comes straight from the contribution margin formatted income statement. Remember, sales minus variable cost equals contribution margin, minus fixed costs equals operating income. Our formula is contribution margin divided by operating income gives us what we call operating leverage. Okay? Company A has sales of 100,000, variable cost 60,000, giving a contribution margin of 40. Total fixed cost is 30, operating income 10. Therefore, 40,000 contribution margin divided by operating income of 10,000, this company has operating leverage of 4. And what that means is, for every 1 percentage point that revenue increases, operating income will increase 4 times as much. If sales increase 10%, profit will increase by 40%. So let's go ahead, let's plug that in. If sales increase by 10%, variable cost would go up by 10%, contribution margin goes up by 10%, fixed cost does not change, that's the key here. So 110 minus 66, contribution margin is 44,000, fixed costs do not change, they're fixed. Operating income is now 14,000. Now, this year operating income is 14,000, last year was 10,000, that's a $4,000 increase. And let's just do the math. Profits did in fact go up by 40% because our leverage was 4 times. So revenue went up 10%, 10 times 4, profit goes up 40%. Our formula would be current year profit minus previous year profit divided by previous year profit. There's our 40% increase. Okay? Now your operating leverage will change from year to year, but it's still a useful tool. Companies, for example, health spas like LA Fitness, 24-Hour Fitness, most of their costs are fixed costs. So each additional person they sign up, that's mostly profit. Okay? Give you a little bit of negotiating power when you go to sign up for a gym. Okay, folks, that'll do it. Study.